Uniforms and workplace supplies. Sounds like the most boring, predictable business on earth, right? Well, wrong. Welcome to this explainer. Right now, Vestis Corporation is at the center of an absolute tug-of-war on Wall Street. It's a classic battle, a gritty domestic turnaround story going head-to-head against a harsh, structural global reality. The stock has skyrocketed. We're talking over 200% in just the past year alone. But the analysts, they are completely divided on where this thing goes next. You've got signs of a massive profitability boom clashing directly with shrinking revenues. So is this a brilliant turnaround, or are we looking at a massive value trap?
Part 1. The Vestis Tug-of-War. Turnaround or trap? This slide perfectly captures the battle lines being drawn right now. In the bull corner, you've got Stifel slapping a $14 price target on the stock, really praising management for expanding those margins and generating cash. But then, look at the bear corner. Zacks Research actually downgrades the stock to just $9.50. Their point? Top-line revenue actually missed estimates, and the company still posted a negative net margin. It's a real tug-of-war.
And make no mistake, guys, this is not some retail-driven meme stock rally. Institutional investors own over 97% of Vestis. That means this is a major battleground for the big players. The smart money is fiercely divided here on whether Vestis is actually cutting its way to sustainable growth or if they're just masking deep structural weaknesses.
Part 2. Shrinking volume, surging profits.
Now, normally, a revenue decline is a massive red flag, right? Top-line revenue fell 1.8% year over year. But here's the paradox we need to talk about. Their adjusted EBITDA, which is essentially their core operating profit, surged 23% to nearly $81 million. So you have to ask yourself, how on earth do you shrink your revenue but wildly increase your profits?
Well, the secret is what management is calling shedding empty calories. Volume, like the actual physical pounds of laundry they processed, fell 4.5%, but they actually deliberately fired their worst customers. Vestis realized they were hauling laundry that only brought in 55 cents per pound, but get this, their overall cost to process a pound of laundry is $1.24. They were literally paying to do other people's laundry. Dropping that dead weight was just an absolute necessity. By cutting all that unprofitable weight, they finally broke a year-long flatline, driving revenue per pound up to $1.42, all while keeping their costs completely anchored. You add in a 9% improvement in plant productivity, and you get massive operating leverage. In an asset-heavy, truck route business like this one, prioritizing margin over pure volume, that's exactly the prescription they needed.
Part 3. Cash flow and debt. Improving the financials.
Management is so confident in this new, leaner strategy that they just raised their free cash flow guidance for the second quarter in a row. They bumped it up by $30 million. They're now projecting a free cash flow conversion rate of roughly 53%. For us as investors, this is absolutely vital. It means their paper profits are actually turning into cold, hard cash in the bank, and that provides some immense downside protection.
So what exactly are they doing with that cash? They're aggressively fixing the balance sheet. They paid down $30 million in debt this quarter alone, rapidly dropping their net leverage ratio from a pretty worrying 4.8x down to 4.1x. So look, if we stop right here, the domestic turnaround story is highly credible. They're leaner, they're highly profitable, and they are deleveraging.
Part 4. The European benchmark, the global gold standard.
But, we can't look at Vestis in a vacuum. To really gauge their value, we have to compare them to Alis SA. Alis is the dominant, undisputed heavyweight champion of uniform rental over in Europe. They generate nearly $4.8 billion annually, which makes them almost 3 times larger than Vestis. When you put them head-to-head, Vestis' structural disadvantages become painfully obvious. Think about it. Vestis is a brand new spin-off fighting tooth and nail for capital entirely within the US. Alis, on the other hand, they operate across 28 different countries with this highly disciplined M&A playbook that Vestis just simply doesn't have the balance sheet to even attempt right now.
Part 5. Moats and margins. The structural reality.
Look at the sheer contrast in the unit economics here. Even with Vestis' recent internal improvements, they're operating at roughly a 13% EBITDA margin. Alis, they operate at a massive 30% EBITDA margin. They are literally more than twice as profitable. And the crazy part is, Alis is doing this with significantly lower debt. They're sitting at 2.5x leverage compared to Vestis' 4.1x.
So how do European peers like Ellis actually achieve this? Well, they built these virtually impenetrable economic moats. We are talking about hyper-dense, localized delivery routes and incredibly strict regulatory certifications for European cleanrooms. That kind of stuff creates massive switching costs for customers. Vestis is definitely taking some great steps by optimizing their US routes, but let's be real, they are miles away from the localized, almost monopoly-like moats that those European giants enjoy.
Part 6. Turnaround or trap. The final verdict. So we have a very clear tug-of-war, but here is the ultimate kicker when it comes down to valuation. Despite Entellus having dramatically better margins, lower debt, and a way deeper economic moat, it trades at roughly 8 to 10 times EV to EBITDA. Meanwhile, Vestis, the structurally inferior business, is trading at 10 to 12 times. You're literally paying a higher premium for the weaker company. Entellus is actually cheaper, though of course it does carry some foreign exchange risks for US investors.
Which leaves us with this final, provocative question. Vestis is doing exactly what it needs to do internally, right? They're shedding those empty calories, they're expanding margins, and they're paying down debt. But is this domestic turnaround enough to actually justify its premium price tag? Or are the European giants simply playing a different, far more profitable game entirely? Let that sink in as you analyze the uniform industry going forward.